Rent versus buy lie. Why homeownership is not an investment. Rent is throwing money away. It's the most expensive sentence in the English language. If you live in America, Canada, or the UK, you've heard this from the time you were old enough to open a bank account. It's treated as a fundamental law of physics. Gravity keeps you on the ground, and homeownership makes you rich. Your parents believe it because for their generation it was largely true. Your real estate agent believes it because their commission depends on you believing it. And you probably believe it because every time you write that rent check, you feel a little pinch in your chest, a feeling that you're burning cash that could be building your future. But what if I told you that for a massive percentage of the population, buying a house isn't an investment? What if I told you it's a lifestyle luxury that actually destroys wealth compared to the alternative? Today, we're going to look at the math that the real estate industry doesn't want you to see. I'm going to introduce you to the 5% rule. It's a simple mental model that will tell you exactly when to stop renting and exactly when to stay put. By the end of this video, you're going to see why a guy named Jason, who did everything right, ended up $45,000 poorer than the renter next door. This isn't just about a down payment. This is about the next 30 years of your life. My name is David, and I spend way too much time thinking about the rent versus buy decision, so you don't have to. Let's get into the numbers. Let's look at a real-world scenario. Meet Jason. At 28, Jason felt the pressure. He'd saved up $42,000. He was tired of his $1,900 a month apartment in a suburb of Denver. He wanted to settle down. He found a house for $420,000. He put his 10% down, that $42,000 savings, and financed the rest at a 6.8% interest rate. On paper, it looked like a standard, responsible move. But let's look at Jason's actual monthly cash flow. Mortgage, principal and interest, $2,470. Property taxes, $420. Homeowner's insurance, $180. HOA fees, $215. Total monthly housing cost, $3,285. Jason went from paying $1,900 to paying $3,285. That's a $1,385 increase in his monthly burn. But Jason didn't care. He told his friends at the housewarming party, "Yeah, it's more expensive, but I'm building equity. Rent is 100% interest, right?" Wrong. 4 years later, Jason's life has changed. Maybe he's looking to move for a job, or maybe he's just checking his net worth. His home is now worth $445,000. It's gone up, but the market has cooled significantly. His remaining mortgage balance is $352,000. Jason looks at his equity and sees $93,000. He feels like he's won. He thinks, if I had stayed in that apartment, I'd have nothing. Now, let's look at the Shadow Jason, the version of him that stayed in the $1,900 apartment. If Shadow Jason had taken that $42,000 down payment and put it into a low-cost S&P 500 index fund, and then took that extra $1,385 he wasn't spending on a mortgage and invested that every month too, in 4 years at an 8% return, his investment account would be worth $138,000. Jason's home equity is $93,000. His alternative liquid wealth is $138,000. Real-world Jason is $45,000 poorer than Shadow Jason. And it gets worse. Shadow Jason's $138,000 is liquid. He can sell it in 24 hours. Real Jason's $93,000 is trapped in his walls. To get it, he has to sell the house, pay a 6% realtor fee, which is $26,000 gone right there, and pay closing costs. Jason didn't build wealth, he bought a very expensive hobby called homeownership. Why does this happen? It happens because we are taught that rent is the only unrecoverable cost in the world. We think that every dollar we pay into a house comes back to us. But the truth is that owning a house has hidden rent. These are costs that vanish just as completely as a rent check. They do not build equity. They do not increase your net worth. They are just the cost of occupying a space. I use the 5% rule to simplify this. The 5% rule breaks down the 3 main unrecoverable costs of owning a home. Number 1, property taxes, 1%. You don't truly own your land, you rent it from the government. If you stop paying your property taxes, you'll find out very quickly who the real owner is. In the US, the average property tax is about 1% of the home's value per year. On a $500,000 home, that's $5,000 a year, gone. Number 2, maintenance and repairs, 1%. Houses are physical objects subjected to the elements. They are constantly decaying. Your roof has a 20-year lifespan. Your HVAC has 15. Your water heater has 10. When you factor in painting, plumbing, landscaping, and appliances, you will spend on average 1% of the home's value every year just to keep the house from falling apart. This doesn't make the house worth more, it just keeps it worth what it was worth yesterday. Number 3, the cost of capital, 3%. This is the silent killer. If you have a mortgage, you are paying interest. That interest is rent you pay to the bank to use their money. If you paid cash, you are losing the interest you could have made if that money were invested in the stock market. When you blend mortgage rates and the opportunity cost of your down payment, it averages out to roughly 3%. 1% plus 1% plus 3% equals 5%. That 5% of your home's value is what you are throwing away every year. The calculation, take the price of the house you want to buy, multiply it by 0.05, divide by 12. If you can rent a similar house for less than that number, you are financially better off renting. If renting costs more, buying starts to make sense. Let's look at how this applies to different cities right now, because the biggest mistake people make is using national advice for a local problem. In San Francisco, the median home price is $1.2 million. 5% of $1.2 million is $60,000 a year. Divide by 12 and your break-even rent is $5,000 per month. But wait, you can rent a $1.2 million condo in San Francisco for about $3,500. If you buy that condo, you are effectively throwing away $1,500 more every month than if you just rented. In San Francisco, renting isn't just a choice, it's a massive financial advantage. In Austin, Texas, median home $550,000, 5% rule break-even $2,292 per month. Actual median rent $2,100 per month. Renting is still the winner here, though it's closer. In Cleveland, Ohio, median home $230,000, 5% rule break-even $958 per month. Actual median rent $1,200 per month. In Cleveland, the math flips. Buying a house in Cleveland is actually a way to save on unrecoverable costs. The problem is that people in San Francisco are listening to financial advice that only applies to people in Cleveland. They are buying houses because that's what you do, without realizing that in their specific market, the ownership premium is so high it's actually a liability. Now, I know what you're thinking, but David, you're ignoring the fact that houses go up in value. My house will be worth $2 million in 30 years. This is where we have to talk about the difference between nominal returns and real returns. Most people look at the price their parents paid for a house in 1975, $45,000, and the price they sold it for in 2015, $450,000, and think they made a 10x return. But they aren't accounting for inflation. According to Robert Shiller, the Nobel Prize-winning economist who created the Case-Shiller Index, the real return on housing over the last 100 years is only about 1% per year. Think about that, 1%. The stock market's real return over that same period is 7% real. If you put $100,000 into a house and it grows at 1% real return, in 30 years you have $134,000 in real purchasing power. If you put that $100,000 into an S&P 500 index fund at 7% real return, you have $761,000. People feel rich from their houses because it's the only form of forced savings they've ever had. They see a big number when they sell, but they don't realize how much more they would have had if they had just been disciplined enough to invest the difference. Homeownership isn't a great investment. It's a mediocre savings account that charges you for the privilege of putting money into it. Beyond the 5% rule, there are two hidden killers that make buying a house even riskier than the math suggests. The realtor tax. When you sell a home, you usually pay a 6 to 7% commission to real estate agents. Then you pay closing costs, title insurance, and staging. It often costs 8 to 10% of the home's value just to move. If you buy a $500,000 home and sell it 5 years later for $550,000, you think you made $50,000. But after you pay $40,000 in selling costs and the $15,000 you spent on the new HVAC and the property taxes you paid for 5 years, you actually lost money. You have to stay in a home for at least 7 to 10 years to break even on the transaction costs. In a world where people change jobs every 3 years, homeownership is a massive anchor on your career mobility. The minimum versus the maximum. Rent is the maximum you will pay for housing in a month. A mortgage is the minimum you will pay. As a renter, if the roof leaks at 2 a.m., it's a mild annoyance. You call the landlord. As an owner, if the roof leaks, it's a $15,000 crisis. This volatility is what kills wealth. When you have a massive, unexpected expense, you stop investing in your 401k. You take on credit card debt. You lose the consistency that actually builds wealth over time. So, am I saying you should never buy? Of course not, but you should buy for the right reasons. Buying a house makes sense when the math works. Rent in your area is significantly higher than 5% of the purchase price. You are settled. You are 100% sure you will